Warren Buffett's top 6 dividend stocks. We're going to run through these and analyze whether or not they are undervalued, whether they are a buy now. We're going to run through each one's historical performance. We're going to take a look at them in the valuation model, getting to the intrinsic value and the acceptable buy price, given our investor margin of safety, as well as looking at what Wall Street forecast over the next 12 months. The results will surprise you. Let's jump into the first one, which is the mammoth that is Apple Incorporated. Now, last year they are up around 40%. We can see they are trading towards the mid to upper end of the 52-week range with a current yield of 0.52% and a forward PE of 28.1. So if this is one you have been holding over the last 10 years, you would be up an incredible 855%. Now let's take a look at the metrics. Dividend safety score 99, very safe. We can see the market cap 2.9 trillion. They are a mega cap company. And when we take a look at those key recessionary metrics, well, they didn't pay a dividend during the last recession. Plus 14%, which is above the average growth. Remember, S&P 500 recession growth was negative 12%, but they also had a near recession return of that of the S&P, negative 50 versus the S&P 500's negative 55. Dividend growth, as always, we advocate on the channel 4% or more year on year, as the US inflation rate over the last 40 years was 4%. So a mediocre increase, in my opinion, in May last year. Last 5 years, well, 7% on average, and over the last 10 years, 9% per year on average is a lot more positive. And we can see they have been increasing those dividends for the last 11 years. So let's take a look at dividend yield theory. As always, it states a company is undervalued when the current yield sits above the 5-year average, 0.52 versus 0.64. So we have a sign here of slight overvaluation. Bearing in mind, though, we're not looking at any of these models in isolation, and we will draw conclusions towards the end of the episode. Forward PE 28.1 versus the 5-year average of 25.9. And when we compare it to the information technology sector PE at 24.5, Apple is sitting slightly higher. So as always, we focus on the free cash flow payout. The earnings, as we have here, are susceptible to manipulation by management through accounting. My personal preference, below 60%, gives me faith management have that ability to offer double-digit increases. For Apple, we can see, in fact, it has been decreasing, and 2023 at 15% is very, very low. I would really like to see a double-digit increase from Apple over the next few months. Free cash flow per share, well, $2 in 2014, $6.33 in 2023. It has been increasing, as we have seen. However, it did drop from 2022, $6.87. So I would like to see this go up in 2024, especially with the release of the Vision Pro this year. Sales growth, 3 to 7% is steady, moderate growth. Double digits is what we love to see. But as we can see, they have been fairly inconsistent. In fact, 3 of the last 10 years negative growth. 2023 coming in at minus 3%, so something just to be aware of there. But over the longer term, 183 billion revenue over the last 10 years has gone to 383, so very positive to see. And on top of that, they do a lot of share buybacks, as we can see, reducing the amount from 24.5 billion to 15.8, essentially returning excess cash to investor pockets. So let's take a look at the ROIC. As always, 10% or more gives us faith that management are able to effectively allocate their capital. 60 to 65% over the last 2 years, absolutely phenomenal. It is what we love to see, and it makes us happy that in fact they aren't paying too much in dividends, as they are having a very high return on the capital they're investing into the company. Both operating margin and free cash flow margin, absolutely phenomenal, consistently around 30% on the operating margin and there or thereabouts on the free cash flow side. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the balance sheet strength and dividend safety. 0.44 showing us the number of years it take them to pay off all of their debt net of cash on hand. Very, very low, very positive, especially when the maximum we look for is 3. So that is a strong sign for Apple. So let's jump into the valuation. And as always, if you're enjoying this type of content, smash the like button, hit the subscribe and bell button so these videos do drop to your doorstep daily. Now, typically on our deep dives, we do run through every single one of these models. For today's episode, let's jump straight into the intrinsic value calculator, which for Apple today is the average of the 3 models that you see. Now, the current price sitting at around $185, $86. Margin of safety, what we typically start off with, 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we can see for Apple is pretty much $1 or $2 shy from that. So right now we see around a 10% margin of safety based on the current trading value. Wall Street, well, they believe the share price over the next 12 months hit around $203. So they see 9% upside over the next 12-month period. As always, when we are running through these episodes, let me know your thoughts, whether you are adding any of these or whether you are a bit more cautious moving forwards. Moving on to stock number 2, none other than the famous Coca-Cola company, ticker symbol KO. Now, over the last year, it is down around 4%. It is trading in the midpoint of the 52-week range with a yield of just over 3% and a forward PE of 22. Now, if you've been holding this over the last 10 years, you would be up around 53%, bearing in mind it doesn't include those dividends reinvested. Dividend safety score 80, so it is safe. Market cap 259 billion, a mega cap company. Recessionary data then, they increased during the last recession, above average growth at negative 5%, and they also outperformed the S&P with a negative 31% return. Latest increase then in February last year, 4.5%, slightly higher than inflation. It does signal that we are expecting an increase next month. Last 5 years in line with inflation, last 20 years at 8%. So it isn't anything fancy. It is very consistent dividend increases year on year. And importantly, they are a dividend king. They have increased those dividends for 50 years or more, and in fact been paying a dividend for the last 103 years without a reduction. Now, dividend yield theory, we can see the sign of reasonable valuation with that yield of 3.08 versus the 5-year average. But we do note the forward PE is sitting slightly lower at 21.7 versus the 5-year average of 24.2. Although do note Coca-Cola's PE is higher than the consumer staples sector of 19.6. Now, because this is a more mature company, I am happy to increase the free cash flow to 70 to 80%. And what we can see here, in fact, over the last 10 years, it has been straddling around 80%. 2022, 80%. 2023's annual report is expected to show a 77% free cash flow payout. But as always, do subscribe and hit the bell button so when the Coca-Cola annual report and quarterly report comes, we will analyse that on the channel. So not too bad in my opinion in terms of the free cash flow. Free cash flow per share, well, 180 to 220. It has increased, but again, do know the inconsistencies. It is a more mature company, so understand that when you are investing, don't be expecting strong growth year on year. And when we look at the sales growth, it is shown here. In fact, they had a significant portion of the last 10-year period where it had negative growth. The last 2 years, double digits, 2023 expected 6%. So something just to keep an eye on, as you don't want to be investing in companies where they have a long period of negative growth. Total sales then, as we can see here, 47 billion to 43. In terms of share buybacks, they do share buybacks. They've also issued shares, but the net position has been a share reduction over the last 10 years, as we can see here. ROIC then, very consistent and above 10%. 2023 expected 18%. It is something I do like, and it is one of the most important metrics in my opinion. And if you did watch yesterday's episode where we talk about the magic formula for investing, it was one of the 2 formulas. So let's take a look at the margins. Well, positive on both counts, operating very high at around 30%. Free cash flow margin as well, very, very strong. It is a very consistent company. You do know what you are getting with the Coca-Cola company. Net debt to EBITDA, it is nice to see from that COVID year it has been decreasing, 2023 at 1.8. So this is a positive sign in my opinion. It has started to come down, and 2024 is expected to come down even lower. So let's take a look at the valuation for Coca-Cola, and as always you can click on the pinned comment below to grab a copy of the valuation model, getting to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or even those on your watch list. So a 10% margin of safety as we start off with is a buy up to $61.52. At 15%, it isn't just a buy yet, so you can argue between 10 to 15% for the Coca-Cola company. And in terms of Wall Street over the next 12 months, they see the share going to $65, so around 9% upside. Let me know if you have been adding this. It is a very popular stock in the community, especially for those that do like consistency in their portfolio. Moving on to dividend stock number 3, we have AXP American Express. Over the last year, up 20%. They are trading towards the upper end of the 52-week range with a forward yield of 1.3% and a forward PE of 16. Now, over the last 10 years, it has been fairly inconsistent, but do note it is still up around 103%. Dividend safety score sitting at 80, it is safe. Market cap 135 billion, a mega cap company. And when we look at those key metrics, well, they maintained the dividend during the last recession, below average growth, and they trailed the S&P with a negative 82%. So something just to consider for those that see a recession inbound. Last year, 15% increase, very nice to see. It means over the next few days or weeks, we should be expecting another increase. Last 5 years, 9%, last 10 years, double digits. Lots to like here for dividend growth investors, but do note they have only been increasing the dividend for the last year. As we did see in 2020 and 2021, it did remain flat, but over the last 27 years, they haven't reduced that dividend. Now, let's get into dividend yield theory. Again, a sign of reasonable valuation with the yield roughly in line with the 5-year average. And we can say the same for that forward PE. When we analyze it, it is sitting higher than the financial sector PE at 11.1. Now, let's take a look at the free cash flow payout. Well, very low in 2023, expected 9%. So this month, I would like to see another strong double-digit increase to American Express's dividend. Free cash flow per share, well, $6.90 to $25, and again, expected to be in line with the previous year. So inconsistent, but overall, it is moving in the right direction, which is what you want to see in all of the companies you are investing in. Sales growth, well, COVID wasn't a great year in 2020 as we saw, but it did rebound nicely in 2021, and even in 2023, they're expecting double-digit increase to the top line. Numerically, we can see 30 billion to 51 billion in 2022, 23 expected 54. Look at this is a very positive sign. They are buying back their shares at a very rapid rate, 1.09 billion to 752 in 2022, around 30% share buybacks over the period. Now, a return on equity, very nice to see, well above 10%. In fact, the last 3 years in the mid to low, in fact, 30s, so very strong. Gives us faith in management and their ability to effectively operate the company. And free cash flow margin, very, very strong, above 5% year on year, 2023, 34%. Lots to love about American Express. And finally, when we look at the net debt to EBITDA, we can see it is expected around 0.18, so it is very, very low. So let's jump into the valuation. And don't forget, if you enjoy the content, smash the like button, hit the subscribe and bell button. It does let me know the type of content you enjoy, and I will continue to bring that out for the community. So margin of safety for American Express, we start off with 10%, and we can see a buy up to 189. At 15%, it isn't just a buy quite yet. So between 10 to 15% margin of safety. What do Wall Street expect for American Express? Well, they see around $200 to the trading price, and as we can see, around 8% upside over that period. So let me know if American Express is one you have been buying over the last few weeks and months. We then move on to what I believe to be incredibly undervalued Chevron Corporation, ticker symbol CVX. It is pretty much trading at the 52-week lows, a dividend yield of over 4%, forward P at 11. Over the last year, it is down 17%, and over the last 10 years, up around 21%. In terms of dividend safety, 90, very safe. Market cap, 273 billion, a mega cap company. Now, when we take a look at those recessionary metrics, increase the dividend below average growth, but outperform the S&P with that negative 34% recessionary return. Latest increase last year, 6.3%. So again, we are expecting an increase this month. And over the last 5 years and 20 years, fairly admirable increases on average 6 to 7%. And you are locking in a decent 4 to 4.2% increase. They have also been increasing those dividends for the last 35 years, so they do get that dividend aristocrat status, and they've been increasing, or in fact not increasing, but paying dividends without a reduction for the last 111 years. Very, very strong and a very long time. So let's take a look at dividend yield theory. We can see effectively a sign of reasonable valuation. 4.16 versus the 5-year 4.04, and we can see that forward PE slightly lower at 11.3 versus the 5-year average of 12.8. Now, when we compare it to the sector PE, energy is sitting very slightly higher at 11.9. So let's focus on the free cash flow payout, and we can see over the last 2 years below 60%, 2023 expected 55%. So it would be nice to see a very nice dividend increase this month. Free cash flow per share, again, do note the cyclicality of the oil and gas industry, negative 1.56 to 19.5, although it is expected to come down significantly to 10.8 in 23's report. Sales growth, again, it shows that essential cyclicality and volatility. Negative increase or negative growth, in fact, over a few year period, and then the same but positive over the next. 2023 top line negative 11% expected. Total sales then, if you like to see the numbers, 212 billion to 236. Shares outstanding, they do a combination, share buybacks, issuing shares. Overall, the net position is a very small 10 million increase over the period. So let's take a look at the ROIC. Again, we can see a lot of cyclicality, but 2022 and 2023 are looking very positive for investors. Margins, again, more of the same, although note the last 3 years on both of them are looking fairly positive for this oil producing company. Net debt to EBITDA, very positive to note, 2022 0.17, 2023 0.31, 2024 expected roughly the same. So we can see why that dividend does remain to be very safe, and we can see essentially why this does a good looking company. So let's take a look at the valuation. Now for CVX, the intrinsic value in today's episode is coming to $178. Now, when we take a look at the current price with a 10% margin of safety, we see an acceptable buy up to $160. At 15%, 151, and at 20%, not just there yet. So you have between a 15 to 20% margin of safety for Chevron Corporation. In terms of Wall Street and what they see, well, they believe the share price to go to around $180. So that is around 22% upside over the next 12 months. As always, this is definitely one that I'm keeping a very close eye on and could be very likely to be my next purchase in the portfolio. Now moving on to the next stock, we have Bank of America Corporation. Now they are releasing their earnings today. We can see they are down around 4%. They are in the mid to upper end of the 52-week range with a yield of 3%, forward PE of just under 10. Now over the last 10 years, you would be up around 96%, but we can see their all-time high from the beginning of 2022 at just under $50. Dividend safety then, borderline safe, 55, 262 billion market cap, so a mega cap company. Now when we look at the key metrics, well, they cut the dividend in the last recession, below average growth, and probably one of the worst recession returns at negative 92%. 9.1% increase in July last year, so that is positive to note. 17% on average over the last 5 years, again very nice, but do note negative 2% over the last 20 years, signaling they have done a dividend cut, as we can see clearly here. So they have only been increasing those dividends for the last 9 years. Dividend yield theory, we have that sign of undervaluation, 2.9 versus 2.43, but we see that forward P at 10.9 sitting fairly in line with the 5-year average. And when we compare it, is again pretty much in line with the sector P for financials. So let's take a look. Now, we don't typically look at the free cash flow payout for banks. It is a lot more volatile. So on the earnings, below 40% is essentially the target for the banking industry. And it has been pretty much below that, with 2023 expected 25%. So I would like to see another 9% increase at a minimum this year. Earnings per share, well, 90 cents to 3.19, expected to go higher in 2023, so that is positive, and it does look to be fairly consistent for the large part, although they do have 1 or 2 years where it does drop, so that is also reassuring to the investor. Sales growth, we can see the cyclicality of also the banking industry, similar to the oil and gas, so we can see the negative growth followed by positive growth. 2023 expected 6% to the top line. Numerically, 84 billion in 2013 to 93 in 22, 23 expected 97. And again, it is positive to note they do share buybacks, reducing their count significantly over the last 10 years, nearly 3 billion shares bought back. Return on equity then for the last 5 to 6 years around that 10%, so that is positive to note. And finally, when we do take a look at the last metric here for the net debt to capital, we can see it is not a meaningful metric for banks, similar to the net debt to EBITDA, which we typically look for. So let's jump in for Bank of America to the valuation and get to the intrinsic value. So we can see for today's episode for Bank of America, we are getting an intrinsic value of pretty much $40. Now, with the current price at $33, a 10% margin of safety is a buy up to $36, 15% around $33, and when we look at 20, it is pretty much in between a 15 to 20% margin of safety for Bank of America. Wall Street, well, they see the share price to go to around $37, so they envision around 13% upside over the next 12 months. Do let me know if this is one that you are looking, or any other banks, especially as today banks are releasing their earnings. Now we're moving into stock number 6, which is Occidental Petroleum, one that Warren Buffett has been increasing his portion in his portfolio over the last few quarters. It is down around 11% over the last year. Over the last 10 years, in fact, down 35%, but we can see it pretty much towards the 52-week low with a yield of 1.26% and a forward PE of 14.5. Dividend safety score 60, borderline safe, market cap 50 billion, a large cap company. And when we look at those key recessionary metrics, well, they increase the dividend, below average growth, and also outperform the S&P with that negative 23% return. Now, they had a very huge increase to the dividend in December of last year at 22%, although do note they did have a dividend cut, hence why we see the negative numbers and the flat 20-year average, as we can see here. So even though they have increased it by 33% or 22 as we saw above, it isn't as high as the pre-pandemic levels of the yield, and they've only been increasing those dividends for the last year. So let's take a look at dividend yield theory. We have that sign of undervaluation, 1.54 versus 0.88, although do note the forward P is significantly higher than the 5-year average of 9.7, and the energy sector P is significantly lower. So let's take a look again at that free cash flow payout. As we can see, 9% expected in 2023. So I would imagine a very large increase to their dividend this year as well. Free cash flow per share, well, $6 to $13. Again, 2023 is expected to drop, as well as 2024. So just know the industries that you are looking to invest in. As I always say, for the more cyclical companies, try and buy them when they are out of favor, as then they will increase the most. Now we can see here strong double-digit negative growth followed by double-digit positive growth, just to reinforce that essential cyclicality. 20 billion to 37 in 2022. Now, shares outstanding, unlike the other oil and gas companies, they have issued shares, therefore diluting your position over the last 10 years. ROIC then 24% in 2022, 13 in 2023. So that is positive to note for shareholders, especially those who have been holding this company for a long period. Operating margin 24% in 23, 25% on the free cash flow margin. Again, very positive, but you always do need to be kept up to date with these industries, as you don't want to be holding them when they do go out of favor and plummet significantly. Net debt to EBITDA 0.88 in 2022, increasing in 2023, so something just to bear in mind, probably why we did see that dividend safety score sitting at borderline safe. So let's take a look at the valuation of Occidental Petroleum. And don't forget, smash the like button if you've enjoyed today's episode. Hit that subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, if you want to grab a copy of the valuation model, click on that pinned comment below where you can get to the intrinsic value and acceptable buy price of companies on your watch list or even those in your portfolio. Margin of safety then for Oxy, we put a 10% and we can see it is pretty much a few cents shy. So it's trading at a 10% margin of safety. Wall Street expect the share price to go up to $69, so they see nearly 20% upside on this Warren Buffett favorite stock that he currently holds and has been adding in his more recent quarters. As always, let me know your thoughts and comments about these stocks. Are there any that you believe to be undervalued or any that you are perhaps adding over the more recent period? Catch you all on the next episode and take care.